In the third quarter of 2025, Warren Buffett's Berkshire Hathaway sat on a record pile of cash. $382 billion. Not stocks, not bold new bets, cash, and short-term government paper parked and waiting. Think about that for a second. The most famous investor alive spent the top of the market selling, not buying. While headlines screamed that he was missing the rally, he quietly built the largest war chest in his company's history. That is not fear. That is a pattern. The wealthy do something very specific before a recession, and it looks nothing like panic. They load up on the boring stuff on purpose. Here's what they actually buy and why the timing matters far more than the ticker. So here's the question. If you knew a storm was coming, would you rush out to buy more sales, or would you check the anchor? Most people do neither. They freeze. When a recession finally hits, the average saver watches the account drop and then sells near the bottom. They turn a paper loss into a permanent one. The stakes are simple. A downturn does not just dent your net worth for a year. It can reset your entire decade. The people who sell in the panic spend years climbing back to even. The people who prepared spend those same years buying assets on sale. Same recession, two completely different lives on the other side of it. The gap between them is not luck, and it is not a hot stock tip. It is what you own the day the fear arrives, and how much dry powder you kept in reserve. That reserve, it turns out, is the whole game. And notice what this really means. The most important moves happen before the recession, while everything still looks calm and green. By the time the news confirms a downturn, the good positioning is already done. You cannot buy an umbrella once you are soaked. So the real question is not what to do in a crash. It is what to hold on the ordinary afternoon right before one. In the next few minutes, you will see exactly what the wealthy move into before the storm. The easy safety plays first. Then the harder assets they quietly accumulate. Then the move almost nobody talks about, the one that turns a recession into their best buying season. Stay to the end, because the last one ties the rest together. It explains why every safe thing on this list is secretly a setup for something else entirely. It is not what it looks like. Let's start with Act 1. The easy safety plays. The stuff you can set up this afternoon without a private banker or a single phone call. The first move is the least glamorous one there is. The rich raise cash. Not because cash is a great long-term investment, it is not. Cash slowly loses to inflation every single year it sits there. But before a recession, cash is not really an investment. It is ammunition. Look at Berkshire again. That $382 billion pile did not appear by accident. Buffett sold stock quarter after quarter and let the cash quietly build. Picture a firefighter filling the truck's tank before the alarm rings, not after. When the fire finally starts, you do not want to be hunting around for a hose. Raising cash feels like doing nothing at all. That is exactly why most people skip it. It offers no bragging rights at dinner. There is no thrilling chart to screenshot, no 10-bagger to post about. And that discomfort is the whole reason it works. The crowd cannot stand holding cash, so they stay fully invested right into the teeth of a downturn. The wealthy are simply willing to be bored for a while. Here is the part that stings later. The person sitting in cash looks foolish right up until the exact moment they look like a genius. That moment has a name, and we will get to it soon. So where does all that cash actually sit? Not under a mattress. It sits in money market funds. These are simple funds that hold very short-term, very safe debt and pay you interest while you wait. In 2026, money market funds hit a record. More than $8 trillion parked inside them, according to reporting on Investment Company Institute data. $8 trillion standing quietly on the sidelines. Think about that for a second. That is not money that lost its nerve. That is money getting paid to be patient. A money market fund is the waiting room, except this waiting room now pays rent. The aside here is almost funny. For years, cash paid you basically nothing, so sitting still felt like a punishment. Now sitting still pays a real yield. The reward for patience went up right as the reasons to be patient did too. And notice the direction of that money. $8 trillion did not flood into meme stocks or crypto. It flowed toward safety, and it kept flowing. That is a tell. When the smart money quietly steps toward the exit and gets paid to stand near it, you pay attention. But a waiting room is only useful if you actually know what you are waiting for. Inside many of those funds sits the single safest thing the rich buy: the Treasury bill. A T-bill is a short-term loan you make to the United States government, usually for a few months at a time. In return, you get a small, steady yield and your money back. In May of 2026, the 3-month Treasury bill paid around 3.7% per U.S. Treasury data. Think of a T-bill as a receipt from the government that says, "We will pay you back soon," with a little extra on top. It is not exciting. It will never go to the moon. That is the entire point of it. When everything else is falling, boring quietly becomes beautiful. The wealthy do not buy T-bills to get rich. They buy them so that when stocks are cut in half, their safe money is still sitting there, untouched, ready to move. And here is the quiet magic of it. While you wait, the government pays you to wait. Your ammunition earns interest instead of just sitting idle in a checking account. There is another reason the rich love T-bills. They are liquid. You can turn them back into cash in days, not months. When the sale of the decade shows up, you do not want your money trapped in something you cannot sell. And moving that money is where the real story begins. That brings us to Act 2. The harder assets. The things that take a little more nerve to hold when the headlines turn ugly. Start with the oldest one of all, gold. When people get scared about paper money, they reach for metal. In 2026, gold traded above $4,000 an ounce, and J.P. Morgan Research forecast it climbing toward $6,000. But forget the price chart for a second. Look instead at who is buying. Central banks, the same institutions that literally print currency, have been buying gold by the ton. More than 1,000 tons a year, several years running according to the World Gold Council. Think about that for a second. The people who make the paper money are quietly stacking the metal. Gold is not a bet on growth. It pays no dividend and builds no factory. It is insurance. It is the asset that tends to hold its footing when trust in everything else starts to wobble. Why do central banks bother? Because gold answers to no government and no printing press. When they worry about their own currencies, they want something no one else can dilute. Gold has done that job for thousands of years, long before stocks or bonds existed. It tends to shine brightest exactly when confidence cracks. The catch is that insurance feels boring in good times and priceless in bad ones. And knowing which of those times you are in is the hard part. Next, hard property, quality real estate and land. Not every building qualifies. In a recession, the flashy, over-leveraged stuff falls the hardest. But well-located property with real tenants and low debt tends to survive just fine. Land does not disappear when the stock market drops. A paid-off rental keeps collecting rent while the headlines panic on your phone. Think of it like a boat with a deep keel. The waves still come, but it does not tip over. The wealthy are picky here. They want low leverage, strong locations, and income that keeps arriving no matter the mood. The aside is worth saying out loud. A recession does not destroy good real estate. It transfers it from owners who borrowed far too much to buyers who kept cash ready. And guess who kept cash ready? The same people from Act 1. There is a quieter cousin to real estate that the wealthy love too: farmland. It sits out of the headlines, but people have to eat in every economy, boom or bust. Land that grows food keeps producing income while the stock ticker melts down. It does not care about interest rate headlines or quarterly earnings drama. That is the appeal of hard, productive property in one sentence. It keeps working when the paper markets stop making sense. The pieces are starting to quietly connect. Then there are defensive stocks. Yes, the rich still own stocks in a downturn. They just own different ones. Toothpaste, soap, soup, electricity. The boring companies that sell things, people buy, no matter what the economy is doing. There is a famous group called the dividend aristocrats. 69 companies in the S&P 500 that have raised their dividend for at least 25 years straight. Names like Coca-Cola, Procter & Gamble, and Colgate. Here is the number that actually matters. In 2008, when the S&P 500 fell 38%, the dividend aristocrats fell about 22% per S&P data. Still down, but a very different kind of down. Think of them as the delivery truck that keeps running through a blizzard. Slower, sure, but it still arrives. People keep brushing their teeth in a recession. That steady demand is why these companies keep paying you while you wait for the storm to pass. There is a second reason the rich lean on them: pricing power. When a company sells something people cannot easily give up, it can nudge prices higher and customers still pay. That protects profits when the economy shrinks. It's not one thing, it is boring demand and quiet pricing power working together. And those dividend payments, small as they seem, matter more than you think. Hold that thought for a minute. One more asset in this act: high-quality bonds, specifically investment-grade corporate bonds. These are loans to strong, stable companies that are very likely to pay you back in full. In 2026, investment-grade corporate bonds yielded roughly 5% according to market data. That is a real return for taking fairly modest risk. In a portfolio, good bonds act like ballast, the weight down in the bottom of a ship that keeps it steady when the deck is pitching. When stocks drop hard, high-quality bonds often hold firm or even rise, softening the blow. Let's be honest, bonds are the least exciting thing anyone has ever put in a portfolio. But excitement is not what you want when the market is falling apart. You want ballast. You want the thing that barely moves, so the rest of the ship can ride out the storm. There is even a name for what tends to happen in a real scare: a flight to quality. Money rushes out of risky bets and into the safest paper it can find, and prices on that safe paper rise. So the wealthy hold high-quality bonds for two payoffs at once: steady interest along the way, and a cushion that often gains value, exactly when their stocks are hurting. Which raises the real question: what is all this careful safety actually for? Here is Act 3. What the wealthy quietly do. This is the part that separates them from almost everyone else. Every safe thing we just covered has a secret job. It is not there to hide, it is there to wait, and then to buy. When a recession hits, good assets go on sale. Great companies get marked down for no reason other than raw fear. Real estate gets dumped by owners who suddenly cannot make their payments. Whole businesses sell for a fraction of what they are truly worth. This is the exact moment the cash was for. Think of it like a sale that only opens its doors when the world is terrified. The price of admission is having stayed calm and liquid while everyone else was chasing the last of the boom. Buffett has a famous line: "Be fearful when others are greedy, and greedy when others are fearful." That is not a mood. It is a schedule. The dry powder from Act 1 becomes the down payment in Act 3. Picture a shopper who skipped every full-price sale all year, patiently waiting for the 1 week everything is marked 70% off. That is the wealthy in a recession. While others are forced to sell at any price, they are calmly writing checks. The distressed deal, the fire sale, the panic seller. To the prepared, those are not disasters at all. They are the entire reason the cash existed in the first place. Look at the history, and the pattern repeats. The biggest fortunes are not usually built in the boom. They are built in the wreckage right after it, by whoever still had money to spend. In 2008, while banks were begging for rescue, Buffett was writing billion-dollar checks on his own terms. He did not get lucky in the panic. He arrived at it loaded. That is the difference between watching a crash and shopping in one. And that flips everything you have been told about recessions right on its head. Now let's be honest about the catch, because there always is one. Holding cash has a very real cost. It even has a name: cash drag. Every year you sit in cash, inflation quietly nibbles at it, and you miss whatever the market happens to gain. If you had gone fully to cash in early 2023 and waited around for a crash, you would have missed one of the strongest market runs in years. The uncomfortable truth is that nobody rings a bell at the top, not even Buffett. He raised cash for quarter after quarter while stocks kept climbing, and plenty of smart people called him washed up. Timing a recession perfectly is close to impossible. So the honest version of this is not sell everything and wait in cash. That is just a different gamble in a nicer outfit. The honest version is keep a reserve you can actually live with, stay mostly invested, and make sure you are never a forced seller. The goal is not to predict the storm. The goal is to make sure the storm can never force your hand. There is a second trap worth naming. Going all the way to cash also means you have to be right twice. Right about when to get out, and right about when to get back in. Miss the second call, and you sit in cash through the entire recovery, watching the sale you waited for pass you by. Almost nobody nails both. That is why the reserve is a slice, not the whole pie. Being early looks an awful lot like being wrong, right up until it suddenly doesn't. So here's the twist, the thing that ties every single item together. The rich are not panic buying safety. They are preloading. Run through the whole list again in your head. Cash, money market funds, T-bills, gold, quality property, defensive stocks, good bonds. Every one of them shares a hidden feature. They either hold their value in a crash, or they pay you small, steady amounts while you wait. And those two features do exactly one job. They keep you liquid and calm when everyone else is frozen and broke. The panic seller and the patient buyer are standing in the very same storm. The only difference is that one built a reserve and the other did not. Here's what almost nobody tells you. A recession is not the disaster. For the prepared, a recession is the sale. The dividends and the bond interest and the T-bill yield are not the prize. They are the fuel. Small repeated payments that quietly refill the tank so that when prices collapse, there is always a little more dry powder to spend. The wealthy do not fear the downturn. They budget for it, months in advance. So here's the line to remember. The rich don't buy the panic. They prepay for it, then buy what the panic leaves behind. Go through that list one more time, and you will see it clearly. Every safe asset was really a loaded spring waiting for the one moment it was built for. Picture two neighbors. Call them Dana and Marcus. Same jobs, same salaries, same house on the same quiet street. For 3 years, Dana kept a reserve and looked almost comically overcautious. Marcus was fully invested and felt clever about it every single month. Then the recession came, the way it always eventually does. Marcus, frightened, sold near the bottom just to stop the bleeding. Dana took her reserve and calmly bought the exact assets Marcus was dumping. When the recovery finally arrived, Dana owned more than ever, all of it bought at a steep discount. Marcus spent the next several years just clawing his way back to even. Neither one of them predicted the future. One simply kept dry powder, and one did not. That is the whole difference between them. Remember that record pile of cash Buffett was sitting on. It was never about being scared of the storm. It was about being ready to go shopping the very moment it hit. If this made the next downturn feel a little less scary, subscribe. The next video breaks down the first asset I would actually buy.